Hi guys, so today I'm going to be talking to you about some of the basic concepts about stocks. This is a presentation made with basic concepts in mind and ideas. This is for new students who are new to the stock market and trying to grasp the basic concepts of stocks. So what are stocks? Stocks are a share in the ownership of a company. For example, if you believe Tesla is an amazing company and you see it has great cars and does very well in business, it's kind of hard to copy or buy the business all cash, right? So the easiest way to be in a part of this company is by buying shares of the underlying company. For example, if you have $20,000 and you want to be part of Tesla as a stakeholder, you go and buy $20,000 worth of shares in the company, and you easily become part of Tesla as a shareholder. Also, very important, stocks represent a claim on the company's asset and earnings. As you acquire more stocks, your ownership stake in the company becomes greater. Sometimes you hear different names for stocks, but whether you say shares, equity, or stock, it all means the same thing. Stocks are traded on exchanges, which are places where buyers and sellers meet and decide on a price. For example, if you want to buy Microsoft, what are you going to do? You're basically going to go to the stock market and buy the stock. There are two major stock markets in the US. One is called the New York Stock Exchange, and the other is called NASDAQ. NYSE is about 200 years old, and the NASDAQ is about 45 years old. The NASDAQ has lots of tech companies. To buy stocks, you need to open up a brokerage account and buy the shares through there. So, what is stock trading? Stock trading simply means buying and selling a stock for a profit. Now, you could trade in different ways. You could use technical analysis, you could use fundamental analysis. Fundamental analysis is basically deciphering the financial statements, so the income statement, the balance sheet, the cash flow. Now, for technical analysis, is basically deciphering the charts and seeing support and resistance and different signals like reversal patterns and head and shoulders. So, what do traders really do? Stock traders try to find a good price to buy stocks. When I say good price, I basically mean that you're trying to buy the stock as cheap as possible and then sell the stock as expensive as possible. You buy cheap and sell expensive is one of the many ways of making money in the markets. You find this opportunity to buy stocks at a cheap price by using technical analysis, which we explain in the next few slides. So then, what are charts? Charts contain information about the price at which the stock has been bought and sold. They also contain information about the amount of stocks traded known as volume. So a basic chart will always have two things, price and volume. This is a candlestick model which we are looking at and we explain more in depth in other courses. Buying stocks can make you money by three type of forms: dividends, appreciation of the price, and shorting. A company may issue dividends to its shareholders. A dividend is a payment that a company will pay to its stockholders from its reserves or profits. When a company does well and has excess cash, they will typically either reinvest it to grow their business or they will pay out a portion of it to its shareholders. A stock's value may increase over time as the company grows, so your share is going to become more valuable. A stock can go up for many reasons. Maybe a company has a new product, that seems to be a great seller. This is a graph of an ideal long position. Long position is basically buying a stock and waiting for it to increase in value, as we see here with the ticker Amazon. Fun fact, a ticker is the abbreviation of a publicly traded company. For example, Amazon's ticker is AMZN. As you get more familiar with the company, you start to understand and get to know the tickers. Did you know if you would have bought Amazon stock at its initial public offering, which was $18 in 1997, and held on to today, you would have been a millionaire at the moment? If you would have bought 200 shares, a value of $3,200, you would have been sitting on a whopping $1.6 million in profit at the moment. Selling first and buying later is called going short. It is done when the market is going down or in a bearish market. So you short when you expect the stock to go down, either because there's bad news or bad earnings. This is how an ideal chart should look like when shorting a stock. You want a downtrend like this when shorting a stock. This is a more detailed explanation of how a shorting looks like. There are three animals in the stock market: the bulls, the bears, and the pigs. The bulls are the people who think that the stock will go up and hence they buy to profit from it. Bears are the people who believe that the stock will go down and hence they sell to book profit or short sell the profit from it. The pigs are the ones who are clueless and always get slaughtered. They don't know why and what they are doing, and hence they always lose money. These are 95% of the traders out there that they don't know what they're doing. In this course, we're going to learn how not to be a pig. There are three major emotions in the markets: greed, fear, and confusion. When the trend is up, the market is bullish. There is greed in the market when there's a bullish market. Never, remember, never go short when there is greed. Bulls are always in control. Fear. When the market trend is down or bearish, there is fear and panic in the stock market. We use it to go short or exit the exiting positions we have currently. Remember, never go long when there is fear. Bears are in control. Confusion. A lot of the times the market is confused. We call it as non-trending or sideways market. 60 to 70% of the time, markets has sideways trend. It is smart to sometimes avoid trading. Thanks for watching. Now you have a basic understanding of the stock market and stocks. Now I want you to go to the next videos and get more advanced and more in-depth in certain topics.